Hello amazing forex traders, welcome once again to this my channel. On today's topic we're going to be explaining all my entry models. So I know you are excited, but just calm down, I'm going to be explaining my entry model from E to Z. So if you're that kind of a trader that is suffering from entering and exit, so this video is for you. But still, if you're a trader that you're not suffering from entry and exit, you can still watch this video to pick out one or two from it. So everybody is an illiterate. It's not everybody is an illiterate in one thing or the other. Another person again is illiterate in one thing or the other. So you cannot just be I all know everything. So let's go to the charts. Now on this chart here on the daily time frame, first thing first, you know I'm a top-down analyst, so I won't be explaining anything on this chart until I've gone to the higher time frame, back to this lower time frame to start explaining what is on this chart. Now, but before I go to the higher time frame to start breaking things, I have to classify my model of entry. I have 4 models of entry, I think. Is that it? So, first one, I have the circuit breaker. Secondly, I have the candlestick entry model. Thirdly, I have the fake out slash continuation model. Then fourthly, I have the change of structure, or you can call it change of character. All these I use them on a lower time frame. Each of them has their own main uses. You understand me? Each of them has their main uses and each time frame that are mainly effective. Now, all these model of entry are very effective, but all of them are being classified on how they are mainly used. Now, I'm going to be going to the monthly time frame to explain. Now, this video is going to be like a trader talk, but still, I'm going to be explaining my models of entry so that you can pick one or two from it and refine it according to your way according to the way that best suits you. Understand? So let's be going to the monthly time frame, in which I skip from the monthly time frame to check for I skip from the monthly time frame to the 4-hour time frame, this and that, because I classify my model of analysis into 2 parts: market analysis and entry and exit. So very simple and short. So going to the monthly time frame, once again, before I continue this video, if you know you are a new trader, you are new into this channel, make sure you don't skip. Make sure click that bell icon to subscribe. Click that bell icon so that anytime I upload a video, you'll be among those that will be notified, so that you won't be left behind, because I got many things and my videos are mainly juicy, so, and they are very educational content, so don't miss out. Click it, subscribe and like. So let's go further. Now, I'm on the monthly time frame. I mainly look for the direction, the bias on where the market is likely going to. Now, let's go to the monthly time frame. Now, on the monthly time frame, I'm going to be reanalyzing just to look for the directional bias. How do I look for the directional bias? I focus on structure. That is one. I focus on structure. Two, I focus on change of characters. Now, according to my change of characters, I'll be explaining it now. My change of characters are double bottom, double top, head and shoulder, inverse head and shoulder. Are you getting me? Triple bottom, triple top. Now, these are the mainly type of reversal patterns that I'm looking for on a higher time frame, such as the daily, weekly, or monthly, but mostly effective on the monthly and weekly time frame. Once you see it on a monthly time frame or on a weekly time frame, it gives you a high probable that market is going to reverse. Now let's go to this chart now, in which we are now, to find the direction of this market. Now, starting from here, I want to explain from here. I don't want to start explaining from this past data. Starting from here, you could see a low, a high, you could see a lower low, you could see an equal high, you could see a lower low, you could see a low, higher low. This is a low, this is a high, this is a higher low, because it didn't take out this side. This is a higher low. This is an equal high. This is a higher low. This is a higher highs. This is a higher low. This is a higher high. This is a further push to the downside. So I'll classify this as a higher low, and this is an equal high. Higher low or equal low. You understand? High, low. You understand? Then lower low. Are you seeing? This is a lower low. This is a lower highs. So you can see that market has changed structure, and market also created something like a double top, because this thing was bullish. This side was bullish, but as market came to this side here, market supposed to at least give us a higher high respecting the direction of this market. But what could you see? Market came to this point here and be reacting for some months. For how many months, I don't know, but you can see that it's a lot. Has been ranging within these two zones, this resistance and support zone, for many months before it went out up, maybe faked out some traders, then pull back down. You getting me? So I classify this as a double top. Then this is the neckline, because you could see how smooth this place is. Market broke it out. Then so let me stop doing like this. Let me zoom well so that you can see what I'm explaining on a clearer view. Now where am I? You could see when market created. I want to settle down to explain for you the reason why this market is bearish and why I think the market has changed structure. Now carefully watch, so they can understand me, and so that me and you won't be arguing. For some traders that already know some minor parts on finding market direction, so I want to explain this in very nicely. Now you could see that market on a higher time frame was bullish. Now this is a resistance zone that turned to support. Market came back to it, supposed to pull from this resistance zone, the support zone, and create a higher high respecting the bullish buyers. Now what do you see? Market has been ranging between this place. Now if you use a Fibonacci, because you all know that there's no how I trade without using Fibonacci. If you use a Fibonacci from here, I think if you drag it to this upside, it will give a very nice Fibonacci zone. Now a very nice Fibonacci zone. Now let's use the Fibonacci to arrange this. When market pull back down, I see it created this whole bearish engulfing candle. Engulfing how many month candle? 1, 2, and 3. One whole month candle engulfed this. Let you see how sellers are mainly entering it with high volume. That is one. Two is that when it came down, it broke this resistance zone that turned to support. This support zone that turned to resistance zone. Now it broke it out. What do you see? Further push to this key level here. That also intersect together with this Fibonacci and support. Now when market came to this place, we're expecting a further push to the high. You understand? Further push, creating a higher high. But market, what was market doing? Market was reacting between this Fibonacci zone, this support zone, with the resistance zone, because these two of them here are very high trade, like they are very high position, like very strong position. Though this one was very strong because it intersected together with the Fibonacci, but still this one also was very strong. So they were fighting between it. Remember that the sellers are highly in control because they entered with high volume. Now you have to know what volume is. Now what do you see? Market came in, was reacting for some months, for many months. Now when market came here, it had the ability. That's when a lot of seller and buyers entered and had the ability to break this upper zone. Now we're expecting market to pull back to it and create for us a higher highs. But what do you see? Market came here, shallow to this point here. Here you see shallow to it, closer to it, then what? It reverse. Now as it reverse, it dropped for us this equal, what they call it here, and it broke it with another two candle, 1 and 2, cleared out all these candles here, all these ranging candles here. It cleared out. So we have one and we have two. Now what you see as sellers are mainly in control of this market. Sellers are mainly in control of this market. Now market broke the neckline of this double top. This is the neckline. because you know how strong this Fibonacci zone is. Now let me take out this Fibonacci. I don't like my chart looking nasty or dirty. Remember, now market took it out and what came to this third touch of this trend line. Remember what I always preach about, the third touch of the trend line always does the trick. Came to this third touch of this trend line, reacted on this third touch of the trend line. Then what? A very nice buy pressures came back. Now this resistance zone held it because this is a neckline of the double top. Held it, pushed back down. This trend line also held it. Push it back up. This resistance zone held it. It now created this smaller candle here. This, let me say, an indecision candle. Then what do you see? Followed by this other candle. So it looks like a reversal candlestick, though the reversal candlestick was not that powerful. So what do we see? We saw another reversal, another candlestick here. And this candlestick came with very nice momentum, but close below this low. So we're expecting this thing to break out below it, like maybe this bearish candle. Then we're expecting a further push to this end. But because of this trend line is holding this thing from breaking down. So we are seeing this is really like a break of the line, then a continuation will soon occur. That's my calculation. But this trend line is a factor holding this, making this thing can be able to reverse at any time to the upside. Remember that this is a push, but just minorly changed structure, minorly structure, but it has not fully changed structure because of this factor here holding it. If this thing can clear out this support zone, then we'll be expecting market to come to this place, because you know the theory of price action, market move from zone to zone. You all know that market move from zone to zone. If you want to know that, check some of my videos. I explain it very nicely. Now, since we see this here, we're going to be going to a lower time frame, the weekly time frame, to check for any obstacle, any chart patterns that will likely make this thing to pull to this next zone here. Now, remember that I said that this is a breakout of the neckline, pull back to the neckline, then a continuation is here. That's what we're expecting, because this just changed structure, and you know market move from zone to zone. So if market has come to this zone, pull back to the neckline of this place, next zone will be here. That's where we're expecting market to come to. Now we're going to be going to the weekly time frame to check for any possible points where market may likely not go to that next zone. Now, what can we see? We could see this thing very clearly. You could see this thing very clearly on the weekly time frame. The market broke out with the from the neckline, retest back to it, then continuation, and the continuation was that trend line holding that held this from coming to this next zone. Now, if you see very well, there is this confluence, there's this resistance zone, support zone here. The market is also reacting on. Now, let me just drag a line on it, a horizontal line, so that you can see what I'm explaining. So this is a factor that's stopping this market from going to the downside. This is just the factor stopping this thing from going to the downside. But there's also another thing I want to explain for you. The main reason why this thing may likely go to the downside is because this thing is on the third touch of the trend line, but the trend line did not intersect with any support or resistance zone, just like this. It did not intersect. If that it intersect with a nice key level on the weekly time frame, or on the daily or on the monthly time frame, then I'll be expecting this to pull to the upside, creating a high. But this is just a minor confluence. If you look at the confluence of these points when markets change of structure, and with this one here, you know that this one here is more higher than this one here. So market likely pull this next zone, this point here. Now I've classified it already. If you check past data, what market has been doing, when market came back to this third touch of this trend line, you will see that the third touch of the trend line also intersect together with this support zone. So when market came back here first time, it went to this upside. This resistance zone held it, pushed back down to this third touch of the trend line. Now that's what created a higher high. But when market came back to this point here, there was nothing like a support zone that corresponds this thing to. a support zone, like a key level, like this on the monthly time frame or on the weekly time frame. Nothing like that. This thing, I'm expecting this thing to drop. Now back to the weekly time frame. Now on the weekly time frame, you could see the obstacle I'm preaching about. This is the thing that is stopping this market from going to this key level. Now you could see the market came to this place, reacted back to this zone, came back again, reacted back to this zone, came back again, reacted. So market may likely go back to this zone. You understand? Because of the rule of what do they call this? The rule of anytime market comes to a support zone, we're expecting a further push to the upside. You understand that maybe main market comes back down, it breaks. You understand? And this is simply a touch of the key level. So market may likely roll to the upside before pulling back down. But still, remember, we are reactive trader. We don't just anticipate. We react to what the market may likely do. Now, since we have seen an obstacle, so we either wait for market to clear out this point here, maybe with this type of candle, clear it out very nicely, then waiting for a correct pullback to this zone, or we will go to the daily time frame to check for any points of any way we can take advantage of this trade. Now, I'm going to be taking out that line because I remember I said I don't like my chart looking anyhow. Now, on the daily time frame, you could see a very nice double top on a key level. This was the neckline. Market broke out, retests back on it, came back, retest back to this small point here, but the pullback were all looking very small. So me, I don't trade in other small pullbacks except I go to a lower time frame, and I don't like scaling to a lower time frame for entries. Now, market now created a very nice pull. Now this was the one I traded. I traded this. Yeah, I traded the to buy to the upside, though I was at risk, but you understand. So then when market came here, this was when I took advantage of the buy of the sales. This is one clear example of my entry strategy. This works like magic. Remember, if you want to learn, you guys subscribe to that channel, subscribe to this channel, like, in fact, share it to your friends, because this knowledge I want to explain to you, you can't buy it in the market. You can't pay me for it. You may be watching your mentor video. Let me not brag, but the model I want to explain for you works like magic if you understand it and if you find it your own suitable. You understand what I want to say, so I don't want to continue speaking too much English. Now let's continue. This was when I took advantage of the trade from here, then I drag it down to this point here. You understand? This is why I closed my trade, because this was the low, so I took it down to this point. So but I took 2 points to this point here. So at this point here, I made, it was how many pips trade, but I made times 2 of the trade. So that is where my entry and exit strategy comes into play. So book your seatbelt, because I'm going to be releasing the nice stuff. So what did you see? Market created a breakout, a very nice breakout, and a retest. And you know that I'm a retest trader, so I cannot just see this and just let it slide. So I already know that on the monthly time frame the market is bearish, because market just shifts direction. So I'm going to be catching the sales of this. But looking at this, market created this massive buying candle here. I look at it, it won't look like a marubuzo. Yes, it's a marubuzo candle now, if I'm not mistaken. So market came back here with a very high momentum sales buy pressure, came back to this key level. And you know that I'm a Fibonacci trader, so before market created that thing, I've already done the analysis, waiting for market to pull back. So dragging my Fibonacci from here to here. So our now market came back to that point there. Market came back to that point there. I'm coming on to drag this very well. Yeah, I think so. Now market came back to that point there. Are you seeing? Market came back to that point there, and what are you seeing? This is my support zone that turned to resistance now, that also intersect together with a 50 fib and a 60 fib. Though this 50 fib was below the resistance zone, but market came to the 50 fib, retested it. Can you see this small bearish candle? That will show you that it obeyed the 50 fib, then it faked out, coming back to this resistance zone. Then what created something, is it a Maribosa again, then back again. So this is what I'm going to be explaining to you, how to take advantage of trade with, and what are the things you need to jot down. So make sure you bring out your pen and your jotter so that you can jot down this, or your journal, so that you can jot down these key points and jot it down very well. All points I'm saying, make sure you jot it, and also backtest before putting this into play. Not everything I say with my mind that you just go directly and start implementing with your money. Please and please make sure you backtest and make sure that you find an edge to reach this exact strategy, because I may be using it and making money, but you may try using it and it may not work for you. So make sure you know what you are doing. This is a disclaimer. Now what did you see? Market created this, because I know that this is a very nasty pullback. This is a very nasty pullback. I don't trade this type of pullback. I trade this type of pullback. This is what they call, to any impulsive move, there must be a correction move, like a ranging market. Like there must be a very consolidation. To any impulsive move, there must be a consolidation. So this consolidation was looking very matured, but this consolidation, it was looking so fast. It wanted to look like an impulsive move. So when this thing was created, I was looking at the candle. So when this candle created 1, 2, 3, 4, 5, and I started to see loss in momentum. Are you getting it? Loss in momentum. The candle was not great. Like you see this candle, it started creating momentum, then very nice momentum, then very nice momentum. So this is an impulsive move. But you see this momentum, decrease in momentum, decrease. You understand? Like a trader moving high speed, then later on he saw something at his front. He had to catch his break right from when he saw it. So from a distance, he saw the obstacle and he started catching the break to reduce it. So that's what this thing did here. So when it came here, I realized, yeah, and this was a 50 fib, so I took advantage of it because I knew where to take my trade to. Then what do you see? Voila. Understand? Voila, market came back to this point here. So I'm going to be explaining to you how to take advantage of all these things and what are the disadvantages and this. Some of them I usually just used to just take some trade, while some of them I usually used to take a very high, because I'm a swing trader. I'm expecting market to drop to this low time from here, so I have a strategy to use to catch the long of this, to in fact to catch the sell of this candle, the sell of this market. So how do I want to do it? I'm going to be explaining for you my entry model, but before that I'm going to be explaining to you what DXY is currently doing at the moment. So what do you see what DXY did? Because of this impulsive move here, DXY have to consolidate very further, a nice further move. So we have nice pullback, nice. So this is looking a very nice matured pullback, and this also intersect this. And if you check very well, market, this is Friday. What's time of Friday? Let me show you. This is 12:58. That is 12:58 already. So we have 2 minutes for this candle to close. And what do you see? You will see. Let me take out this Fibonacci so that you will see what I'm explaining here very clearly. Now I'm expecting this to drop, so I'm going to be taking out this so I can see my screen nice. So what do you see here? Some reactions here. Now we are judging this now based on volume and momentum. You see this small candle here, this indecision pin bar here, this very correct impulsive volume here. Now we now saw another, all these things are daily candle. We now saw a daily indecision candle. We now saw another daily in the stock count that is currently forming at the moment. Remain only just 2 minutes. Okay, let me just see seconds for this candle to close. Are you getting me? Now, if you check this candle very well, you see it looks like a marubozu. Sorry, like a tweezer top. This is a tweezer top candle because it is looking equal. Now, if I take my horizontal row and drop this on top, you could see why I say it is looking like a tweezer. And you all know what tweezers are. Tweezer is a very nice candle. So this is looking like a tweezer top. This is a tweezer top on top of a key level. Now let's judge this by what the confluence are. Now we could see decrease in pressure of momentum 1 and 2 on a key level. Daily time frame candle, decrease in momentum. So decrease in momentum of this, and we could see a tweezer top on us at this point here on the daily time frame. So we have one daily time frame in the decision candle, another time frame in the decision candle, daily time frame. So we have two on a resistance zone. Now together, that resistance zone also intersect together with E Fibonacci, and this is also looking like a very nice matured pullback. I get it. If that this pullback was not a very nice matured pullback, it would have just blown to the upper side, just like the way this one blew to this. But when market came irrespected, it pulled again. It came here irrespected. So if you see this very well, only this candle that is here created a very nice pull. A very nice pull. So for this thing to be able to engulf this, it took how many candles? 1, 2, 3, then 4. But this one is not 4. And you could see again that this resistance zone, all these candles are closing below it. Now a confluence to back this up for you to know that this is also bearish. This may likely drop to the lower time. Now number 1 is this resistance zone. 2, Fibonacci. Market came closer to this 60 fib retracement level, but it did not come above it. So maybe it did not touch it. It now also pull back again and touch the 60 Fibonacci level, taking it out. Now market may likely pull back down. So we have 1 confluence, 2 confluence, 3 confluence for volume, 3 confluence for volume. So I'm going to be checking my EME to see if EME very good. So we have 4 confluence for market to drop. So this is a very nice intersection point. Okay, 4 plus another tweezer top. Now, so we have 5 confluence. 5 confluence all pointing downwards. Are you seeing how I'm breaking out? I'm going from the higher time frame to a lower time frame, checking the main point where market want to go to. Are you seeing? The daily time frame also corresponds together with the monthly time frame direction, showing you a very nice point that market will drop. So, but remember, we don't know if we don't control the market. The market does its things based on our own analysis. If the market will respect our analysis, then we're waiting for an entry model, then we enter it, execute it. Are you getting? So because we know the market will drop, because market is already showing us points that's going to drop. We don't just see market will drop and market will drop. We let the market do its thing. Then when the market are giving us a thing, we ride together with it. Now, so we have 5 confluences that are showing that the market is going to what? Market is going to dump. I get you. Market is going to dump. So let me show you guys before I start coming back to show you first take profit and second take profit. Now, this is for me, to be honest, since I know the market is going to go to the lower time frame there, since we know the market is going to go to the downside based on our analysis and all the confluence that we have gathered now on DXY, now once I go to the lower time frame, I'm not going to be entering on this lower time frame. All these are mainly to find directional bias. Weekly time frame, monthly time frame, weekly time frame, and daily time frame are to find directional bias. Then 4 hour, 1 hour, maybe 15 minutes to find, sorry, not 15 minutes, 30 minutes to find your entry model. Now, the daily time frame should be where you should place your exit. The 4-hour time frame, 1 hour or 30 minutes should be where you should enter your trade. Your stop loss should be on that time frame. Your exit should be on the daily time frame. Am I clear? Very good. Now, what I usually do is I don't put my take profit on this 100% retracements. I put my take profit on this body of this point here. Oh, yeah, that's what I say. On the body of this candle. Now, let me show you. Instead of I to where's that my short position? Let me assume I'm taking trade here. Then my stop loss here. Then I want to take profit. I'll now be placing here. No, I don't do that. I come here to take my trade profit here because market may, according to my findings, market always respects that point there. So 99% of the time market respect that point, and 99% of the time market does not come to this point here. Are you getting me? So it's better to take profits than not to. Don't have big eye. I will always tell you the truth because it's not your father that owns this market. You are just using your analysis or technical analysis to make money out of it. So what will you be proud of? Why will you be doing proud? You just be proud with your chart and be like you be doing Spider-Man, dragging your take profit below. Or that market will come close to your take profit. Maybe you are sleeping and roll over. You wake up in the morning and start crying. And you're saying, you're blaming the market. No, that's how it not. That's not how it works. Are you getting me? So my first take profit there, my second take profit will be here. Are you getting me? So once market should do anything like this, I'm going to be exiting my trade. Then I'm going to be looking for another point to enter. A pullback to that monthly time frame or daily time frame resistance zone. Then I'm going to be dragging my entering trade again, catching it to this point. But if I feel like I can take, maybe I enter 2 positions on this trade, I can close 1 position at this point here or at this point here. Then I drag my stop loss, take my stop loss from here to break even, so I'll be risk free. You understand? Then I'll hold this trade to this point here. So if market should break this point here, I'm looking for a pullback. I'll enter another position, 2 position, carry stop loss from this point here, from break even to this stop loss point here. Then I will carry it here. So I'll be having a lot of profit. So that's what I do if I'm comfortable with the trade. So this is how I exit. So as you can see, I've explained for you how I just exit, how I really exit. So it's not part of what I wanted explaining today, but since it's called for, I have to just explain it to you all. Now, as you can see, the candle has closed. Today's candle has closed. So today's week has finished. Like weekly candle has closed. So we're expecting next week to form. Once next week form, I'll be expecting a candle, a bearish candle like this. Yeah. Once I see a bearish candle engulf a daily candle, one daily candle engulf these 2 candles here, I'll be taking my trade to this point here. Understand? So I'm going to explain it to you all my entry models now. So first thing first, I'm going to be explaining the candlestick model, how I usually enter. So not the candlestick model, the fake out model. Now, starting from here, I'm going to be using past data on how I usually trade to enter it. So now, if you want to check very well, you can see how I enter my trade on candlestick model. Now, starting from this point here on the daily time frame, the candlestick model, especially the fake out candlestick model continuation, fake out continuation candlestick model, is based on the monthly time frame. It's based on the daily time frame, sorry, daily time frame or 4-hour time frame. The idea still remains these 2 time frames, daily time frame or 4-hour, but mainly effective on the daily time frame, but also effective also on the 4-hour. Now you could see now the market came back to this point here, created this pin bar, now created this bullish engulfing candle. And when you see this, you can enter your profit, this thing here. Market will take you here to this point here. Remember here I told you take a profit. Now what do you see? Market came to this candle and take it out. That was the first candle that take out this. And you see market did not just come up here. It had to create another some candles again before it come that upside. Now this is how I entered my trade. Now I don't just enter this, I also take it with Fibonacci. If I don't see Fibonacci intersect with that, I won't take trade with that trade. So I mark my Fibonacci from here to this point here. So let me see. Yeah, so as you can see, this is exactly what I was explaining to you. So market came to that point there. Actually this way my fib zone. So market came to that point there. This was where my support zone was on this point here. I see fib zone there intersects. Let me take out my Fibonacci so that you understand. So this was my support zone. Market came to my support zone, reacted it first time, second time, third time, then fake out with the candle, coming back to the Fibonacci, mainly Fibonacci, respected again, that is this point, respected again, then continuation. So once I saw market bounce back above this support zone, I said yes, market is going to continue because market has faked out traders. Now it's going to continue back to the make direction. So this is how I enter trade with my candlestick fake out continuation strategy. So please, if you don't understand, you can send me a message and I'll reply you. Now that is one. So I'm going to use another one again to explain to you. You can also see the same thing. So some weak rejections, weak rejection, then a key level, then a very bearish engulfing candle. Mainly this I use it on a lower time frame. So I'm going to explain it to you how I do it. But this is on a daily time frame. So what do you see? Market came here, and that's what brought the what they call it to the downside. Now another one again at this point here. You see when market came to this point here, this was a clear Fibonacci level and a resistance zone. Market came here, reacted 1, 2, 3. I will tell you the truth. Many traders enter trade at this point here. Then what do you see? Market faked them out. As they faked them out, created this pin bar. Then as it faked them out, then this one candlestick went back into this thing, resistance zone, showing you that market is going to continue. So this is a fake out continuation model. This works like magic. I'm telling you, 99, that's what I told you. You can't buy this knowledge. I'm giving it out for free. Though it takes time for these candles, this pattern to form. But anytime it forms, I'm telling you the truth, it's a milestone. So it's just like a jackpot. So you drag your Fibonacci from that side to this side. Remember, I told you that these are the criteria that are being needed, that must be met before taking advantage of this. Now, I will always tell you the truth. Now, what did you see? Market came to this 50 fib, reacted to this zone, but it decided no, it want to fulfill technical levels, came back to this 60 fib retracement level, and what went back up below it. And what do you know? Market will drop. So are you seeing example of what I'm explaining here? So please make sure you hold it well. I know that this video is getting long, but still I'm explaining it here, and I'm also trying my best. So as you can see, this happened severally on this pair. I don't know if it also occurred again, but though, yeah, see it here. This one is also the same thing. You see it anytime you see this kind of candle, when market open on a daily time frame and you see it push to the upside and it closed above it, just in the market is going to continue. But I think this happened on a lower time frame, and I took advantage when I draw my fib from here to here. Let me show you so that you know that I'm not just speaking riddles. I drag my fib from here to here. And this was my support zone that broke into resistance zone because it has been respected multiple times. I supply and demand zone. You understand? I classify it into supply and demand zone. You understand? When they are being drawn on a lower time frame, I don't call them key levels. I call them supply or demand zone. So this was my demand zone that changed into supply zone. So also intersect together on my Fibonacci. Market pull back up, reacted on this, faked out, came back to the 60 fib and continue went above. So when you saw this, where do you know market will continue back to this side, or you target here the 100% retracement level? And what do you see? Market came back to this point and so came back to the 0 -0.27 retracement level. I think how this works. So all this works like magic, just for you to know how to use it. Now this way I see it is more effective on a daily time frame. So I've explained for you the best that I can explain to you on how this works. So where does this pair mainly works? It works in any pair, crypto, BTC, crypto, forex, you understand, synthetics. The idea is the same thing. It's just left for you to spot it out and put it well. Remember, it must intersect with Fibonacci and is supply or demand zone, or a resistance or support zone. Anyone you want to call it, anyone you classify it, they're all the same thing. Now, I'm going to be going to a lower time frame to explain to you how to enter trade with circuit breaker. Now, circuit breaker, I mainly use circuit breaker on the 4-hour time frame. Excuse me. Now, circuit breaker is mainly used. Remember, all this that I'm explaining to you, they cannot work without Fibonacci. Though they may work without Fibonacci, but they are not that so legit without Fibonacci. So a circuit breaker is mainly a counter trend line, or you can call it a CTL with a matured pullback. When a pullback comes up, it is not steeper. Steeper pullback is something like this. This is a very nice and steeper pullback. So we don't trade steeper pullback. And we don't use steeper pullback a circuit breaker. If not, it won't work. Are you getting me? If not, it won't work. Remember, I'm going to be also explaining to you how to enter with candlestick. And remember, I explained to you fake out continuation rule on the daily time frame just now. So I'm going to be explaining to you also on 4-hour. I told you that there are two time frames that it works: the 4-hour and the daily time frame. That is all. Do not take it out. The 4-hour and daily time frame, mainly effective on the daily time frame and also effective on the 4-hour, but it's more confident on the daily time frame. Now, the second one that is mainly effective for swing trading is the circuit breaker. Now, I'm showing you the rules that must be met. First thing first, there must be a support or resistance zone. Support or resistance must intersect with the Fibonacci, 50 fib or 60 fib. Secondly, the pullback must not be steeper like this. When market came and it pulled back to this side, you cannot just see because it intersect together with Fibonacci. So you're going to come here and drag your trend line, your CTL, just like this, just like this, just like this. You are wrong. You are wrong. Market will fake you out. Market will fake you out. So you are expected to see a matured pullback that look like half of a yeah, you're expected to see a pullback that look like angle 90. For example, the pullback must create something like this. Let me show you. Half of a triangle. Yes, it must look like a triangle. If you check this very well, this look very matured. The pullback look very matured. If you check it very well, it look matured. You too, you know this matured. So to go straight forward, the pullback must look matured, not steeper. it must have two touches. We have one touch, pull back up. This touch that I say created this impulsive move that came here. Then we have another next touch. This next touch created this impulsive move. Then the next touch, the third touch, remember that the third touch always does the trick. So if market had the ability to react on this place, so we are going to be expecting something on the third touch or the fourth touch. So we'll be expecting markets to, I'm showing you circuit breaker. I'm not trying to tell the market to drop from here to down. I'm just trying to explain to you if markets will come here, we'll be expecting markets to react on this third touch, because you know that the third touch of trend always does the trick. React back to this resistance zone, then from here a break. So from that side a break. Now these are the criteria. When market respect this third touch and pull back to this place, something further, then breakout, creating a change of structure on this point here, then we are going to be a change of structure, not just a change of structure, but the candlestick that created the change of structure is looking highly bearish, like the volume of the is looking powerful. You understand? Either two candle break out of here or one candle break out of here is still legit. Then you can drag something like this at this point here and say that that will be your circuit breaker. That will be your circuit breaker. You can drag a lower key, a lower zone here. Then you can see that that is your circuit breaker. You all know the market will also come back to that point there to retest it before continuing. So there's way to enter this. All of them are all legit. You either enter aggressively at this point here, or you come to this point here and put your pending order at that point there, or to be more conservative, you scale to the lower time frame and use a candlestick pattern. Maybe you come to this point here, on a lower time frame such as the 30 minutes or 1 hour, check for weak rejections, then a reversal candlestick, just like a bearish engulfing candlestick, engulfing all those weak rejection candles. Then you can enter at that point there, sell limits, your stop loss beneath here, then your next take profit at this point. Am I clear? So this is the first one that I used to enter my trade, so I call it circuit breaker. Please and please do not over exaggerate, do not over neglect this. I'm teaching you here for free. I'm the only forex trader here. I think that is always, as you can see, this video is taking lots of time. So you come here, put your short tool at this point here, then stop loss below here, take profits at this point here. So this can be a one-to-one risk to reward. It does not matter, because how legit this thing is, it matters a lot. Then your next take profit should be at that 0 0.1 level, or this point here. Anyone that is left to you, that if you want to switch, anything, but still process, you will still be adding. That's the joy of this. That is the joy of this. Now, or if market should not do that like that, we are going to be waiting, expecting a break, retest, continuation. Now, the rule of this entry model is this. Note, after a break, we're waiting for a retest back to this. We are not just coming here and place our buy, our sell limit here. No, we are going to wait diligently for market to take out this high. Once market can take out this high with a very nice bearish candle, powerful bearish candle, a very nice powerful bearish candle, then we are going to put our stop, we are going to be entering at this point here for our candle closure. Please make sure all the things I'm explaining here are for our candle closure. Then you can drag it down, your take profits. Remember that still take profit above 1 and 2 and 3. You understand? So I'm just explaining this here so that you understand me fully. Now, this is the other one I'm explaining here. So these are the two type of use. The also have an external trend line. Trend line works like magic if you know how it works. Now, so this is going to be an example of the circuit breaker. We have two type of trend line here. We have the inner trend line and we have the external trend line. You know, when market takes out an inner trend line, it comes back to hunt the outer trend line. So that is a rule, just like when you said market move. When I told you market move from zone to zone, that is same thing with trend line. When market clears inner trend line, it goes out to hunt the outer trend line. So we had a first touch, second touch, third touch. Are you getting me? So I should just drag this. Trend line well, so that I like the trend line to be there. So that is it. Now you can see first touch, second touch, third touch. Now also market also came back to this one here, creating this circuit breaker. This is a third touch. Market came back here, created this reversal candlestick, and this is also reversal candle also change structure at this point here, breaking up this place. So you come here, you enter this place here as your entry model, because if you look at the volume of the candle, you could see that the volume of the candle is bearish. It's very bearish, breaking out this. So this is a very nice, or you could wait and enter at this point here to be very sure. Come here, enter at this point here to be very sure. Then stop loss here. Next take profit at this point here, targeting the outer trend line. But still you could see that the risk to reward here is very small. The risk to reward here is very small because we are targeting the outer trend line. So this will be you're risking 2 and you're to get 1. So it does not make sense. For me, I don't do such a thing. I let it just play out. You get me? So now this one, when I saw that trade, for me, I didn't take advantage of it. I let it because I saw there's an outer trend line. So I expected a breakout. Now you can see all the candle that broke out from this trend line was very powerful, showing that sellers are in control. Then a pullback. This pullback that is here was looking matured, came up to this trend line, reacted on the trend line, created this bearish engulfing candle. Bearish engulfing candle here, looking very powerful. And when did I took advantage of it? At this point here. But though I did not say you guys should take advantage of it from there. Remember that I said market has to clear out this point. Now, taking from that side there, did you see if market cleared it out? No, market did not clear it out. Market came to this point here with this bearish engulfing candle and stopped at that point here. But the reason I took advantage of it from there because I looked at this candlestick. Market reacted at this point here, also created an EMA at that point here, a reversal EMA. Very good. Then I took advantage of it here. But it is for you to take advantage of it here. You understand? Or wait for a breakout, a retest again on a lower time frame, a candlestick on a 30 minutes time frame. Take advantage of it from here. Are you seeing? Let me show you. Short position. Take advantage of it from here. The lower time frame stop loss at this point here, or the lower time frame stop loss. Then you can target your take profit. So this will be a 1 to 3 race to the work. So let's see how simple this looks. Are you getting me? Let's see how simple this looks. So for you to see that my entry strategy works like magic. So I'm going to be showing you a lower time frame entry model for those people that are asking how do you enter trade on a lower time frame. This is how many type of confluence, how many type of entry model did I explain to you just now. And remember I told you that they must always correspond with Fibonacci. That Fibonacci is a goal, and that Fibonacci must also correspond to be out a support or key level. You cannot just mark out any Fibonacci and say the market will come and respect it. If it does not respect with any zone, a support or a resistance zone, if it does not respect, it is useless. Are you getting me? Now I'm going to explain to you that fake out continuation pattern I explained to you on the daily time frame. Now you can see market came to this Fibonacci, this trend line here, this zone here, this resistance zone that broke into support, and now it's resistance. Market came out here, faked out traders pull back here. So market was creating higher highs, higher low, higher highs. All this in a substructure of the 4-hour time frame. Remember, the overall direction was bearish. Now market came here, was creating higher highs, higher lows. Let me show you how it faked out traders. Pull back down here to this point here. If you use the Fibonacci from here to here, you found that this also intersect at this point here. So market now also what? Buy. So many traders were buying from here, expecting market to continue. For that trader that are dumb traders, they did not take profit. Maybe they're targeting at this point here. Market came there, did not come that side there. So market came up, creating a double top. Then what? Created this low, little bit of what you call it. Then back to the zone, a 4-hour back to the zone. Now, anytime you see something like this, when market creates something like this minor, small candlestick, then back to this zone, just know what you're going to do. Place your take profit here at this point here, then enter. Or you can wait. You can also look at the candlestick. If you look at the candlestick first, let me use a line chart for you so that you can understand what I'm explaining to you here. That is, if you're kind of person that don't understand, you could see market created higher high, higher low, equal high, equal low, higher highs, higher low, you see, equal high. Now market went back up, came here and broke this point here. This was a clear market structure shift. This where market stopped to before it pull back again, the continuation. So at this point here, when market change structure, that's where you're going to be taking your trade. Am I clear? Am I clear? So I'm coming, let me take out this, take it out. So let me use candlestick, then I'll use another model again for you to get it clear. I want you to understand. Market has been creating this pullback, this. Let me show you how market change structure. This, this, you see, then came to this point here. So if I drag out this, I drag it out to this point here, what do you see? There was a clear change of structure at this point here. Not at that point where I'm arranging, I'm just trying to arrange it so you can see. There's a very clear change of structure at this point here. See, market took out this low. You see, so that was a clear change of structure. So at this point now, you saw that there was a change of structure also, and also this entry model, fake out continuation model. So what do you see? You enter your trade. If you are lucky, at that point there, you can also see an EMA. Let's see if there's an EMA intersection. Okay, there's no EMA, but still it doesn't matter. That confluence is also enough. You get me? So at that point, you can see you want to take your trade from there, from this point here, and taking it to the external trend line, because market always respect the external trend line very well. You understand, more than the internal trend line. Me, I'm telling you the truth. You get me? So you can target this external trend line. Markets can reverse from that external trend line, so you can target it from here to here. So this will give you a 1-to-1 risk to reward. Are you getting this? More preferable. A 1-to-1 risk to reward. Then you can still be holding. Maybe you risk a smaller money that you're willing to, you can just let go. Then you can still hold it from there to here. So this can be a 1 to 3 weeks to reward. Let me just say 1 to 4 weeks to reward. Are you getting? Because on this trading you can enter like many positions. I explained to you. So that is one. If you check again, let me go back. If you check that pullback also, it's also a mature pullback. Are you seeing what I explained? So now what is the next one I want to explain to you? Candlestick entry. So I'm going to be using this point here to be entry, showing you candlestick shifting. Market structure shift. Market structure shifts. Market structure shifts is once you've done your top-down analysis. Once you've done your top-down analysis from a higher time frame and you found the direction, you scale to the daily time frame. Now, once everything has been set, that's when you are required to scale to the lower time frame to look for your entry and exit. Remember, I said our entry and exit start from 4 hours to 30 minutes. Market analysis, monthly time frame to daily time frame. after everything has been met, you scale to the 4-hour time frame where you're going to be looking for potential entries. Now, once market has tapped your 50-pip retracement level, after checking the momentum, check at the point where market is busy reacting. Once you see many reactions, like many reactions, like weak rejections, after these weak rejections, many weak rejections, then you know that yeah, market is respecting the zone. Now you can scale to a lower time frame. Maybe after this weak rejection that you see here, maybe this one here, maybe saw this weak rejection here, you can now say, okay, let me scale to the 1-hour time frame to look for potential entry. Now scaling to the 1-hour time frame. Now you scale to that same point where market did something as that. Now once you see something like this, market is creating on this time frame higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher high, then higher low. You will see now the market created this shift in structure. Now this shift in structure is not the overall shift in structure, because this market was creating these higher highs, higher lows, higher highs, higher lows, lower low, lower high. Are you getting me? Lower low, lower high. What we are going to be expecting is two shift in structure. If something is like this, we're going to be expecting higher highs, higher low, higher highs, respecting this one here, another higher low. So once we see it, we're going to be taking advantage of it down. But we only saw only just one. That's the reason why we're going to be using this point here as our method of entry. This point here as our method of entry, or this one here. Are you getting? So we can drag our long line here from here to here, waiting for a double shift in structure. Once you see, sorry for that. Once you see, like you see what I just dragged there. So once you see a double shift in structure, then we can be very confident to take our trade. You see, this is a low, lower low, higher low, higher high, higher low, higher high, higher low, higher highs. Now market took out this low, but this was like a liquidity grab according to all these people that trade SMC, ICT, inducement. Now you can see a higher high, can see something like this, pull back again. Now we're going to be using this because market took out this high. We're not going to just enter at this point because market shift structure. No, we're going to wait for a double market structure shift on a lower time frame, such as the 4-hour time frame. Remember, you ask yourself, how do we know when to scale to the lower time frame, like the 30 minutes, to look for potential entry? Now I'm going to be explaining to you how to do something like that. Now, but you have to be scaling down gradually. Once you scale to the lower time frame, such as the 1-hour time frame, and you find that market has created a very nice structure shift, then you can say, okay, should I scale to the lower time frame to look for what I'm looking for now? But I mainly did on 4-hour, 1 hour, because this time frame gives me a very nice confidence to take trade, especially on the structure shifts. The 30 minutes time frame does not give me that vibes. It's not that strong. Market can anytime, I'll tell you the truth, at any time hit your stop loss before going to your direction. That's why I choose the 4-hour or the 1-hour time frame. Now you can see more clearer. Now I put my long line here, then I can bold it if I want to. Sometimes I bold it, then I put it appear only on this time frame, only on this time frame. Then also I also put timer. Let me show you. I also put timer. Come closer to it, and I put timer. Come here, and I put add timer. Market creates a timer, so once market breaks it, automatically I come to my chart and I check it if market have close above. Now, so when market crosses, I don't just jump on it because market has crossed it. I jump on it after the candle has closed. Now I don't just jump on it because the candle have closed. I judge also the pull to this place here. The pull to this place. You will see how many candles, 1, 2. So this on it. Are you getting me? So I would either advise you jump on it on this place here, stop loss at this point here, or break you get entry model. Since I've seen my then I've get this market to low. So this point here, short position here, stop loss the high nice. When I use this method of trading, I mainly focus on 1 to 2 risk to reward. Getting on 1 to 2 risk to reward is any other thing give me but 1 to 2 risk to reward. So I'm getting 1 to 2 risk to reward. 1 to 2 risk to reward. Sometimes market may give you 1 to 1 point something risk to reward, then really comes closer to your 1 to 2 risk to reward in reverse, but it's somehow hard. You understand? 75% of the time market hits your TP. 1 to 2 risk to reward and I'm off. Are you getting 1 to 2 risk to reward and I'm off? So what did you see? 1 to 2 risk to reward and I'm off. 1 to 2 risk to reward and I'm off. 1 to 2 risk to reward and I'm off. But to be on the safer side, I go to the daily, the 4-hour time frame to look for my any point where market may likely reverse. Now you could see that this point here, when market was coming back down, we had this reaction here. And when market was coming back up, we had this reaction there. And when markets came back up, markets like it pulled back to that point here. So we can come to this point here, creating something like this. Support zone. A small support zone that will match that point there. So we put it there here. Because why did we put it there? Because if you check well, if you check very well, you could see this imbalance here, like a fair value gap that also intersect together with this reaction here. So we assume that market may likely come to this point here for reversing. So we can just say, to be on the safer side, to put it at this point here. So it may not give us a 1 to 2 risk to reward, but it's more safer. So we can drag it to this point here and be safe. So that is how I trade this market structure shift. But if there was a trend line, remember a trend line, let me assume that there was a trend line like it took touch already, I will drag it to the trend line bottom here. Are you getting me? So that's how I trade. Then I'll be then it will be like a 1 to, let me say 1 to 3 weeks to reward, and I'll be very comfortable and confident in taking that trade. Are you seeing how I classified my listen? And on the 4-hour time frame, to see how powerful that candlestick was. And if you're lucky, you could see that point there also intersect together with the EME, so to give high probable trade. So that's how I do enter trade with candlestick. So which other information entry did I say I wanted to explain it? So okay, let me show you another one again. Let me show you another one again. So on this one here, you could see that market has pulled back to this key level here. Are you getting me? Market has pulled back on that key level there. So as market pulled back, we saw some minor reactions. So we now saw this candlestick one engulf this 1 and 2 candlestick, and that bears engulf all this candlestick here. Very nice. So since we saw this weak rejection and then this candlestick, we'll be going to the lower time frame, such as the 1-hour time frame, to check for a structure shift. Now what do we see here? You could see that market on the 1-hour time frame, market created a double top, 1, 2. This was the neckline. Market broke out with a very nice powerful candle. This is a change of structure, a very nice change of structure. But if you want to be more confident in entering this trade, though your stop loss is going to be very big, you can drag your line here. I'm waiting for additional candlestick to break below. once market can break below with additional candlestick, then I can be advising you to take your 4-hour candlestick closure. One candlestick, maybe one or two candlestick closure above this place here, but the candlestick must be powerful. You can enter your take profit, your entry position, the stop loss above here. Then your next take profit position should be the next external trend line. Are you getting me? The next external trend line. So this is how I enter it. But for me now, I'll be telling you that since market has broken out from this key level and we saw some pullback here, breakout, reaction back to the same place, want to go up, then break out from here, then we saw a change of structure at this point here, then a pullback to this point here, showing you reaction on this place here. So you can just see if you want to enter, though you can enter here. It will be aggressive. You enter it. It's left by you. It's left to you to go and do your analysis for test and back test and get more confidence in it. You enter from here at this point here, because market has pulled back to that point here. You understand me? When market pull back to that point there, you can go to a lower time frame like the 30 minutes. That's what I want to explain to you. 30 minutes to look for a very nice entry model at that same point. Then 1 to 2 looks to the reward and you are okay. 1 to 2 looks to the reward and you are okay. Or the external trend line. Getting so market has pulled back to this same point now. So what we're going to do, we're going to be going to the 30 minutes to check for any possible point, any possible way we are going to be entering this. So we didn't see any way of entering this trade, so I'm coming. So on the 30 minutes we didn't see any form of entering this trade, but if you check very well, if you use a Fibonacci from swing high to swing low on the 30 minutes, let me say this is our swing high and this is our swing low, you can see that market also respected Fibonacci. This Fibonacci intersect together with this zone here, this point here. So maybe market may likely push to the upside before continuing, but to be on the safer side, if you want to enter this trade, since we didn't see any form of confirmation on the 30 minutes, if you want to enter this trade, carry this your what they call it to this point here, because we have gotten one shift of structure, one change of structure at this point here. Then we're looking for additional change of structure at this point here. Once we can see additional change of structure at this point here with a 1 hour candlestick break and closure at this point, we will enter this trade with no at this point now. The time frame is telling us that yeah, market has changed structure 1, changed structure 2. So now we no longer force trade, we are just following what the market is showing us. So we'll be entering our position at this point here. Then because this place will be the low, we're going to be putting this place our low, and our next take profit is going to be the next trend line, outer trend line. So that's how we're going to be entering it. So most market should create a 4-hour candlestick at this point, break out of that side there. I'm going to be advising you to enter the trade with no any other problem. So at this point here, I'm going to be putting a pending order at this point here. I'm expecting the market to change structure. Once I see a double change of structure on this point here, I'm going to be executing, targeting the external trend line. So I'm going to be targeting the external trend line, but once I find out that the market has not the risk to reward is small, I may likely not enter, but though I may likely enter at this point here, stop loss at least at this point here because of spread once the market opens. You understand? Because 4-hour time frame candle is showing nicely bearish. 1 hour time frame candle is also corresponding to that point there, and daily time frame candle is also showing a tweezer bottom. It's also showing a tweezer bottom, a tweezer top. It's also showing a tweezer top and a weak rejection on that resistance zone together with Fibonacci, and it also intersects together with a EMA. So I may I may likely enter it at this point here. At the opening of this. So but what am I going to be doing? I'm going to be risking a very smaller um smaller capital on it. You understand? Smaller capital on this stop loss, at least because of spread, this point position there. So I'm going to be targeting it to this point here, to that point here, because I'm risking a very small money there, so I can be willing to risk it, risk the take the loss at any time, but that does not matter. Understand? Take profit here, then the next one is here. So this is going to be like a 1 to 5 fixed reward. That's if the market should give anything, but still I'm still expecting market to give me a nice circuit breaker at that point there, so that I can be adding additional position at that side there. So at this point here, I'm going to be entering like two positions. So once the market should give me another thing, remember I'm going to be taking advantage. So this is how I take advantage of my trade. I will show you a lot of information on different pairs on how I do it, but this video is getting long, so it's left for you to use the idea that I just gave out and practice it on your account, not on real account. Practice it, practice until you figure out how to use it. If you forget it, you should come back to the video for reference. I try to also do best to explain as I can. So please, if you like how I explain how to trade using the top-down analysis, please make sure you subscribe to my channel, like, click that bell icon, and also share to your friends so that they can also learn. Thank you very much for watching. Have a nice day.